the Business Trendsetter podcast, where we talk about trends and how to use them to grow your business. My name is Manny Turan.
And I'm Adam Hartung.
We're a Spark partners. We're here every week to discuss trends as they pertain to your business. We always talk shop in ways to help you grow your business. And we are one of our mantras is if you're not growing, you're dying. And there's lots of ways to skin a cat. There's lots of ways to reach Rome. One of the central conversations we have with a lot of our clients is the idea of being acquired. Of course, the startup culture this day and age is all about creating something that can be acquired. And I think there's a lot of value to acquisitions, but I think sometimes that there's other ways to be successful. So I know, Adam, we've seen in the news recently with Six Flags sort of being acquired and a bunch of other stuff. So let's kick off the podcast talking about acquisitions and why they're important and what we can be doing to prepare for them and just generally talk about acquisitions.
Sure. Well, as we've said in previous podcasts, there's this magic number of 10% per year revenue growth. That creates long-term sustainability. How do we get there? Well, you have to have 2 to 2.5 points of growth to keep up with the economy. You have to have another 2.5 to 3 points of growth to keep up with inflation. You're just getting right there to 5 points at a minimum that you have to have. Otherwise, people are spending money on other things and you're going out of business already. So that's just treading water in the basic context. But the problem is that if you're just treading that water, you're not making enough money to recover your lost assets. Like things wear out. Desks wear out and equipment wears out and you have to buy new stuff. And then on top of that, stuff becomes obsolete, like, for example, the computer that you're using or the mobile phone that you're using. So you have to buy a new one. And you can't go back and buy the old thing, just buy a replacement because new technology is more productive than old technology. So you have to keep growing in order to have the revenue and the money, the cash flow to invest in things that wear out and to keep yourself current. That's another 4 points. And then you still haven't given anything to your investor yet. So you got to give something to the owner or it's not worth being in business. So that takes another point of growth. So, those numbers are just some roundabout things. It's obviously not a mathematical equation that I've written down for you, but it's a good rule of thumb. You got to grow at 10% per year. So when I say that to people, one of the things they'll ask me is, well, did you mean organic growth? And the answer is no. There's no statistical analysis that I've done over the last 25 years has indicated that the source of the growth has to be something in particular. And does it have to be your current product? No. Does it have to be your current market? No. If you take your current product and you've never sold it in Europe and you go to Europe and you grow, that's growth. And that gets you the revenue you need. If you've got your current customers and you've never sold them Swiss cheese and you start selling them Swiss cheese, that's growth, right? It's growth is good. And then the big one is always, well, if I make acquisitions, does that count? And the answer is yes, you're still growing. And so as long as you're growing, you have a chance. And that's what you want to do. You want to be sustainable. You got a chance to keep the market moving forward. Is try to be able to make sure that you make acquisitions that work for you. Now, that doesn't mean all acquisitions are good. And that's the problem that I have with a lot of activity. A lot of the business, the merger and acquisition business, isn't sitting there thinking, I'm doing this in order to try to keep growing my revenue. In other words, I'll bring this in, grow my revenue, I'll add resources to it, it'll give it more opportunities to explode. I'm going to take my resources and put it into that next big thing. That is a good acquisition, right? But what we see often isn't that. So, let's take, for example, what's going on with Exxon that bought Pioneer, right, at a huge price. And then Chevron bought Hess at a huge price. And so now there's a lot of writing in the financial journals and in the business journals like Wall Street Journal, MarketWatch.com, those kinds of places about what's going to be the next targeted acquisition, in oil and gas. And the issue here is that people should recognize this is the last man standing kind of an acquisition. Yeah. We probably hit peak oil demand a couple of years ago. We're rapidly moving towards electrifying all kinds of things. So automobiles, trucks, hedge trimmers, we're going to batteries. We're moving away from using oil and just so many different things. And as we do that, the demand for the product is going to go down. Today, the reason the price of oil is at its current price, which is around $100, I think, right now, is mostly because of the ability of Saudi Arabia, which has a lot of oil compared to the number of citizens it has. And so it can sit there and say, I'll put out more oil, and that will keep the price down. Or I can hold back and sell less oil, and that keeps the price up. Now, why is it we don't do that? Well, that's because we have, 350 million people in our country. They have far fewer. So their oil resources are so vast compared to the number of people that everyone lives a very, very high quality of life, and they don't have to keep selling oil every month. And they're trying to, in fact, make other investments, as you know, live
Yeah.
golf and other things that to try to expand their business base. But the net of it is that you can't look at the current price and say, oh, the price of $100 a barrel means that the oil business is in great shape. No, the oil business is in dying shape. We know that demand is going to go down from here. It's not going to go up. There are no scenarios in which we see demand for oil and gas going up over the next 10, 15 years. Maybe we'll talk about climate change later today or at a different time. But when we look at the climate change efforts that are going on, what we see is that is really, really a negative for the oil and gas industry. So what we're seeing there is an acquisition where somebody's saying, I'm going to try to be the last man standing with hopes that I buy this thing. And then what I do is I cut costs. So I don't need two CFOs. I don't need two heads of compliance. And so that's kind of high level positions. But you start saying, could I do well maintenance? One guy, he was taking care of 10 wells. Perhaps he could take care of 12 or 13 now because they're in close proximity to each other, less windshield time, right? Whereas I might have had a couple of different pipeline connections to get from the oil well to the main pipeline. Now I could maybe shut one of those off and cook them up and use one pipeline. So that reduces my maintenance and my throughput transportation costs. So those kinds of things are what they're looking at. And they're saying, also I'm buying reserves. And now what happens is I try to get my reserves position close together so that when I want to go out and drill wells, in this modern time, usually horizontal wells, I can get more out of the drilling activity. But the net of it, again, is all trying to say, how do I become the last man standing? And last man standing acquisitions don't work out very well. My example for this is CenturyLink, right? CenturyLink is now has a different name. I'll try to remember in a minute. But CenturyLink, they played fiber. So back in the days when we
Yeah.
really needed fiber, they were the number one laying fiber across the United States and across the oceans. They also they're called Lumen Technologies now. I just got Lumen Technologies. And then they also had all those really rural telephone companies. If you were in an area away from Tucson, 50, 60, 100 miles away, you probably were serviced by a rural telephone district, which was owned by, at the time, CenturyLink. So they did really well in the 70s, 80s, 90s. Things were going well, but then demand for that stuff just dropped off, right? And as cell service reached rural communities, nobody wanted to pay $100 a month for a landline phone anymore. So what they did was they made acquisitions. Their revenue started to go down, and it kept going down. And so they said, you know what, we're going to make big acquisitions to get on track. And they did that, and revenues jumped back up again. But then they immediately started whacking away at costs, all right? So if you go back in time, just go back about 10 years, then what you'll see is that at the time, CenturyLink was about $40 a share, right? And it was doing, looked like it was doing okay. But it's as the revenues kept going down, they couldn't cut costs fast enough, right? And they had no plans for what new markets they were going to develop. They made the big acquisitions, and instead of whacking some costs, investing in something new, they just tried to invest in the business they'd had before. If you went back 10 years ago, they paid a big dividend. You could get something like an 8% dividend yield buying their stock. They were handing the money out. Well, about 4 years ago, they completely eliminated the dividend because they said they needed the cash to try to preserve the business. So one investor said, "Was what's in this game for me? The business is getting smaller. Demand for your products is getting less every year. It costs you money to maintain it. You keep investing, trying to save a dying business because we all know it's going to go satellite. And we're going to need that fiber cable, and maintaining it, people aren't going to pay the rate it needs to maintain it. And now you're spending money on yourself, paying managers to try to keep them on the job so they don't go away." So the company went from $40 a share 10 years ago to $1. That's not a
Wow.
joke. Drought trades for $1 now. You have a company with $17 billion of revenue, and its market cap is less than $2 billion, right? And why? Because there's nothing in it for the investors. Even though they made some acquisitions, they went into this last man standing mode, and they are last man standing. I don't know if there's anybody else in the fiber business but them, and they're trying to use that for some networking tools and things. But they're just it's a nothing business. And so you could see a future out there in 15 years. You start looking and say, what's going to happen to the oil and gas business? Well, it's going to shrink, right? And who's going to be left? And you could end up with this, couple of Goliaths. It could be Shell, and then you could have, Chevron and Exxon. But and again, it's not going to be any fun. Everybody's going to be looking to cut costs. Everybody's going to try to
Yeah.
figure out how we're going to price to try to keep somebody from buying an electric car, and it's just not going to be good. So even though the acquisition itself means that it'll prolong Exxon's life, it gives them more revenue, it gives them the opportunity to sustain. If they don't make really big investments in other things, like I don't know, a nationwide network of electric chargers, or getting into some other real business, then it's not going to work out well.
Yeah. Do you remember when Kmart bought Sears?
Yeah, yeah,
That was a match made in hell.
yeah.
You
Back
know.
about 19, a lot of people forgot this. Back about 1982, Exxon created something called Exxon Office Systems, and they were going to go against IBM. And at that time, we were just before PCs were coming out, but we were really automating companies in a big way. Small companies that could never have computers were now getting what we call mini computers in those days, and so they didn't have to have a big mainframe anymore. And we were really computerizing payroll and a lot of things for smaller companies. And the business was growing really fast. And people had copiers too, and there were copiers on every floor. And they had multiple vendors, and it was kind of complicated. It was complicated, especially for a small business. And Exxon said, we're going to create Exxon Office Systems. They put $1 billion into the business. And we're going to go out and meet these companies and sell all these products. It lasted 2 years. And after 2 years, the CEO is like, geez, we don't know anything about this. And IBM's handing us our head. And, Hewlett Packard and DEC they're doing way better than we are. And I'm not sure that this fight is a fight that, we probably should have never done this in the first place. And they just shut it down. Left all those customers hanging, had their products. I had a guy I went to business school with that went to work for him. Graduated, went in as one of the early people dedicated to Exxon Office Systems. 2 years later, he didn't have a freaking job, right? And it was why? Well, because they had an opportunity to invest it and stick with it. So right now, do I think Exxon's going to take the money that they save and put it in a new business? No, I don't. I really don't. The way they blew the Exxon Office Systems, and I have heard nothing that Exxon, Chevron, or anybody else. The only one that talks about doing this sustainable energy is Shell. And, there's a lot of question as to whether their claims really amount to anything or not. So, again, acquisitions are good if they help you grow the business.
Yeah, I think there's the two-sided coin, right? There's here you are as a business owner acquiring a company, and then there's the other side is you as a business owner who wants to be sold to a company.
Yeah.
And I think that there's cautionary tales on both sides. We just talked about the Exxon situation, and I know we're going to talk about the Six Flag thing in a sec. But I think that you really have to see the stakeholders. I really love your story about the dog food company and that whole private equity thing, but where there's a diamond in the rough, and if you play your cards right and you really look beyond the value delivery, you look at the true value of a company, I think you can extract that and pay some value for it, and then get multiples on top of that.
Yeah.
So I think there's got to be some cautionary tales on both sides. Even when you acquire, when you are acquired, I have some friends that sold their business, and I have one of them that actually it went very well, and they actually were able to cash out, and they made a lot of money. They were only there for a year later, and then they were done. And I have another few friends that they stuck around, and it was not a match made in heaven. It was the acquisition company the acquirer was changed the culture day one, even though they said they wouldn't. They changed everything day one after they had controls of the company. So I think you got to be careful.
Yeah. Yeah, for sure. For sure. I mean, are we going to do something new, or are we just going to cut costs? That's the biggest thing. And most of these turn into a cost-cutting exercise. And as you mentioned, just this week, over the weekend, I think it was, Cedar Fair, Cedar Fair and Six Flags decided that they would merge. And it's going to create one company that'll have 42 theme parks, 15 water parks, and 7 resort parks. For years, these two have been the two competitors with Disney. And Disney really kind of stands alone because they don't try to have multiple parks all over the place, right? But they try to work this as part of their brand. And we've talked in the past several times about how amusement parks just isn't where it's at in terms of growing the Disney brand. And talked about Iger and how I think he's done far worse than Chapek was doing in steering the company. Well, people never saw a reason for these two companies to merge, but they did. And why did they do that? Because the volume and the demand is way off, right? It's just seriously way off. And so, interestingly, theme parks, this whole idea started about 1927. There was a guy named Luna, and he had these he was a roller coaster inventor. And so he'd go put a roller coaster in place, and then he'd put the theme park around the roller coaster. That was 1927.
Wow.
And I'm sure you've seen old black and white movies and seen with Coney Island, right?
Yeah,
You
of
remember
course.
that? And that was very exciting to people when back in the 30s, 20s, 30s, 40s, adults, true adults, I'm talking about people in their 40s, wanted to go to the amusement park. They would go there, they would ride the Ferris wheel. If you watch the movies, you'll see them, wearing suits, going to the amusement park, eating popcorn, ladies in dresses, and it was an evening out. Well, of course, it migrated, and then we had kind of the emergence of this new thought process that came around in the 1960s, 70s with Six Flags. Now, when I was a boy, there was this amusement park in Wichita, Kansas. It wasn't far away; it was a bit, but anyway, we could go there, and it was called Joyland, and we just loved going there. I mean, when I was in high school, you try to get a group of kids together and just beg your parents to, can you take us to Joyland? We want to go there for a couple hours and ride the roller coaster, right? And I would say that certainly remained true even when I was in college. You these local little amusement parks like that. A lot of times you had to buy tickets. You'd go in and you'd buy a roll of tickets, so much per
Yeah.
ticket. And then when you got on the amusement park, you handed the tickets. And it was so many tickets for Ferris wheel. Roller coaster was always the most expensive one, and the scrambler and all that kind of
Yep.
stuff. But now, that's if I'm some young person listening to this talk, they would be like, "What's a scrambler?"
Yeah, they have. I think even for my generation, it was always. I mean, having lived in rural Arizona, the idea of going to Six Flags or even Disneyland or Knott's Berry Farm for the summer was imagine this like
Yes.
dream, right? We're going to go to Disneyland this summer for 2 or 3 days or whatever.
Oh,
Now
yeah.
my kids, they're more interested in what new gaming systems they can acquire and what new VR headsets. And I took them down to the county fair, and I had to almost force them to get on the rides. It's just it's changed, right? It's all changed.
Well, there's a Six Flag Park in Vallejo, California, and as you know, I spend a lot of time in Napa, and I drive through Vallejo frequently, and so that park is not even open 7 days a week, and it's not open even 8 hours a day. They can't get enough demand. It's just north of San Francisco. It's a little bit northeast of San Francisco, and it serves a big population area: Pleasant Hill, Pleasanton, and Walnut Creek, Livermore. So it's a big area that it can serve. But I'm always amazed. I drive by it, and you can tell at night if it's open that evening because the lights are on. Those lights are off, and I go there, and so many nights no lights are on at all. I've driven by it and seen that it doesn't open until 1 o'clock in the afternoon, and it closes at 5. It's only open for 4 hours that day. So what we have here again is another thing where these two companies said, "Well, we just don't have the demand. We're going to merge," and that's just the first sign of we're going to start whacking away at this. And just like Disney needs to find other things to do, these guys got to find something else to do. People don't go to movie theaters, and they're not going to return to theme parks. And of course, the analysts looking at this are saying the same thing. They said there's not going to be 42 theme parks in a year. That's how many they got now, but there's going to be fewer in a year
Yeah.
because they're going to figure out ways to consolidate. They're going to shut them down. They're going to try to get customers to drive a little further to get to these other parks. So in the short term, is it good that they did it? Yes, because they sustained. We want to thrive, right? Our goal is to help our clients thrive, not just make it another year or 2 years. So, yes, sometimes you might want to make an acquisition in order to sustain your business, but you really want to thrive. And that's where I think we should look at Microsoft. Years ago, 10 years ago, I was a very big detractor of Microsoft, but I was really a big detractor of Steve Ballmer. I mean, he was the worst CEO in America for a long time because under him, they didn't do anything but Windows and Office. Even when they bought Skype, even when they bought other technologies, they had an ERP company, for example, and they bought Ericsson in the phone business. They didn't do anything with them. But now they've got a new CEO. And, I was interviewed about 8 years ago. I wrote an article about Microsoft for Forbes, and I said, they should just shut down the gaming division. It had been in existence for 15 years, and it lost money for 15 years. And the Xbox was proverbial third behind PlayStation and Nintendo. And I just said, why, you're pouring money into this thing. It's not getting the attention it needs to try to grow. And consequently, it's the proverbial third losing money kind of a competitor. But the new CEO now that they have in Nadella, he's changed that whole leadership function and the strategy at Microsoft. And, he said, I don't want to be third. I want to grow the business. And he went after Activision.
Yep.
So Activision was founded in '79 by some former Atari employees. Believe that or not, Atari employees. They set off to say, what could we do? And the Atari was, of course, for young people, was one of the original boxes that you could get. You hooked it up to your television as the monitor, and then you had to control.
I remember I had one.
Yeah. and it had games, and you could put cassette games into it to play them. So these people left that business and went just on the gaming side, writing games, and of course that's what Activision became, and Call of Duty is now a huge success. But Microsoft makes a big play here, and they say, look, what we got to do is get out of third and get to first. And how we're going to do that is we're going to we'll make a lot of money. We're doing really well in cloud computing. We're doing really well in software as a service. We've turned the company around. Our price to sales ratio has tripled. It's gone from 3 to 9. Our trend value is way up into the hundreds of billions of dollars now because we've done so much better. The stock price is way up. And so they said, let's quit being proverbial third. Let's go buy Activision, which will now put us in a significantly better position. And a lot of people said, well, the largest software company shouldn't be owned by somebody like that, the largest gaming software company. And they said, no, we'll continue to make for PlayStation and Wii, and we'll continue to give the rights to the European products to a European company. So they made deals with the regulators so that they could get this acquisition done. But here we see somebody making an acquisition for the purpose of growth. They're saying, look, we've always been proverbial third. We need to change the game. And to do that, we need to move beyond this. Our console is the console, Xbox, and our games go onto the Xbox. And of course, they made a big acquisition before. This is the second, but this is much bigger, and it's going to launch them forward. And it'll be, I'm sure, going to be very successful and will pay off. It's kind of like when Facebook bought Instagram. And they paid $1 billion for a company that had 10 employees, right? And it was like, why do you do that? Well, because we want to get into pictures, and it's going to bring more people to our platform. Yeah. And Instagram makes something like $600 million a quarter now profit. So they paid off very well. That's where this Microsoft acquisition is going. So all acquisitions give you more revenue. They can help you to be better positioned. But is it sustaining your business, or are you trying to grow? And the first ones we talked about, the oil and gas and the amusement park companies, I don't see anything there that says they're really trying to grow. They're trying to figure out, how do I be the last man standing? How do I try to kind of, keep the lights on and maybe do something for management, because they're not going to do anything for the investor. That's the big thing. Now, whereas on the other hand, we see Microsoft really making an investment in a big way to move into something new and different that could really grow their business and help them to be, a leader. And that's what you want an acquisition to do for you.
Yeah, I think a lot of companies or a lot of people that are looking at our podcast and we talk about these big companies like Microsoft buying Activision and Exxon and all that, and they seem somehow obscured from that giant play. But at the same time, those companies, whether they're multi-billion or if you have a small company of half a million, all those same principles are the same. I mean, it's just, you've got some other things to do with dealing with investors and all that, and the SEC and all that. But otherwise, there's so much to be learned by watching these giant organizations make decisions. And, I commend you, Adam, for, falling on your sword with respect to Microsoft. And, we're infallible. Of course, we're going to make mistakes and we change our minds. Certainly, I was commented to somebody the other day about, how bullish you were on the whole idea against crypto, right?
Yeah.
Or bearish with crypto, I guess. And so, that has come full circle. We can go into maybe next time we talk about the fall of grace of some of these crypto companies. But yeah, certainly I think it's really pays to look at these giant companies to see how they make decisions, because ultimately you can learn from them.
So when I talk to companies, the small and medium-sized companies, what I really try to help them understand around acquisitions is I'll say, listen, things are happening in the world all the time. And you should be aware of what's happening in the world, because it can affect your opportunity to grow. So as you see things happening in the world, you often are faced with a decision. Am I going to invest to keep up with change, or am I not going to invest to keep up with change? Or am I going to be like Facebook and buy Instagram or WhatsApp in order to continue to be on new platforms, grow my business and go? Now, that's the recommendation if you want to be a long-term, sustainable, successful company with high returns for your investors and the owners. But sometimes people say, this is getting away from me fast. It's a big-time game. I'm looking at the people that are changing the marketplace, and they have money from outside sources like a private equity firm or an investment bank or a venture capital firm. And they're saying they can throw so much money at this in order to try to grow the business. I can't keep up. It's not really realistic for me to think I can keep up unless I want to totally change my financing, unless I want to go to outside money. And I just don't really want to do that, right? It's a different game. It's not why I got into this business. And my answer is always, look, it's okay to say that you want to exit. If you're in a business and you see change coming, you either need to decide, am I going to invest and play? Or if I don't want to invest and play, then I want to start planning my exit. Because what you don't want to do is sit around like Six Flags and get to the point that you're irrelevant, right? You don't want to be sitting there like, oh, I stayed here and now I don't really have any growth prospects. Gee, I think I'll sell. Well, who's going to buy you then, right? The first guys to sell out always get the highest value. That's just absolutely true. There's all kinds of academic research on that. Yeah. If when the market shifts, if there's going to be a bit of change and some consolidation, and people are going to get into a new market, the first guy that gets his foot out the door gets the highest value. And so that's what you have to decide early. And it's a big part of strategic planning for small to mid-sized businesses because it is difficult often to raise the amount of money you need. Raising money can be a tactic that can very effectively thwart competition. Somebody that, as I said, can just raise a lot of money, can do significantly better, and they can run longer at lower prices and lower margins in order to grow their revenue and just run you out of business because you don't have enough money to fight the war at the price point that they can. So that's what you have to look at that and be realistic. Say, I love this business, love what I do, but if that's where the competition's going, I got to invest. Then make that decision. Invest, go raise the money and go chase it. Or B, you know what? I don't think so. In which case, then you say, hey, let's get this business sold and move on to the next thing.
Yeah. And I think that comes back down to scenario planning. We talk about that all the time. If you're not planning for it and it passes you by, and you have to make a decision on the spot and you're not ready for it, you're not going to be able to get the value that you would normally get if you had some level of preparation.
Yep. One thing that you mentioned earlier, and I'd like to make sure our listeners hear, is that oftentimes when these acquisitions happen and you're the seller, there'll be this discussion about what's the seller entrepreneur, what's his role going to be in the new company. Or you could be the buyer and you're having the same conversation. What's the role going to be in? The buyer almost always comes out the CEO, right? It's very rare that the seller comes out the CEO. So the buyer's going to CEO. What's this seller going to do in the organization? And there's always this thing of like, well, we should keep them around for relationships. We should keep them around, for the employees, and we should keep these people around. And my answer to that is no. Why would you do that? The buying company has control. They have a culture, and they should have a plan for how they're going to grow the business, right? It's not your plan for how to grow the business. You didn't want to go down that road, right? You've decided you're going to take the money, and if you're going to take the money and run, then run. Why do you take the money and stay? That doesn't make any sense. So I think it's very important that most entrepreneurs and small business owners realize that when you get ready to sell the business, don't try to keep yourself tied to it. In fact, if you can negotiate something where you say, you know what, you want to buy my business for X. If you'll give me X plus 1, I'll just get out and see what kind of money you could get for that. Because the seller often will say, they probably often don't, the buyer often doesn't really mean it when they say, yeah, we want to keep you around, we want to keep your customer relationships. They're saying that to get the deal done. And if you say, you know what, if you're going to buy this, it's yours. Yeah. You do with it what you want.
Yeah, there's lots of data concerning the amount of time that is requested for from the buyer to the seller. It's usually about 3 years they request. And then the average tenure is less than a year. Yeah. So after, hey, it's not working out, I'm out of here.
And now often another big mistake is say, well, it's going to be X, and you get a certain percentage of X year 1, certain percent 2, certain percent 3, right? So stick around for 3 years to get your money. And that's the buyers have this notion that somehow doing that means that they're going to work really hard to grow the business. That's not true. I mean, it was your business. It's not your business now. It's their business now, right? And they've got a company, and they're going to make the final decisions, and they've got a culture. And so if you make an agreement that you'll take money in second and third years, you don't really want to be there. I mean, it's not your company anymore. Why would you want to make a deal like that? And I would frequently say, take 90% of X and take all of it and get out the door. Now, we all see the lottery being played all the time, right? And it says, well, the lottery's worth X billion dollars. And you get that if you take it over 20 years. Or the other option is to take it all in one lump sum, which is a percentage of that big number, right? And all financial analysts always say, take all the money. Take it all now, pay the tax on it, and then go invest it, right? and set yourself up for a long-term future of wealth. And it's just the same thing I'm telling entrepreneurs. If you're going to sell your business, get all the money now. Get it now, so then you can decide what you want to do. Do you want to retire, or do you want to buy another business, or do you want to become like a venture capitalist and put a little money in some things and then figure out one you love and go buy that down the road? But you can't do any of that if you're tied to the old business and you're hanging around over there. And the longer you hang around, the more you're going to get pissed off, and then the less you're going to be successful. And it's never going to end well. Like I said, it never ends well.
Very well said, Adam. Well, this has been a good discussion about acquisitions and getting into the mind of the buyer and the seller, and a lot of good things. I know that we're going to be taking a break next week, but the following week we'll be seeing everybody back on the Spark Partners podcast, the Business Trendsetter podcast. And with that, have a wonderful week, Adam, and we'll talk to you soon.
See you later.
Cheers.